new true crime podcast you need to hear to believe.
I need police right now. I've just started broken into my house.
2 men dead at the hands of a teenager and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.
The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, he's angrier than a James Hardie shareholder and he's not afraid to show it. It's Anthony Macdonald. How are you, Anthony?
I'm the kid that didn't get any lollies on Halloween, James.
Oh, I feel bad now. This week we explain how the battle lines are being drawn up in the new superannuation wars. We try and make sense of the brutal slapdown investors handed out to two of our biggest companies, and yep, he's back. Richard White is in trouble again at WiseTech. But Anthony, it's been a huge week for interest rate watchers. In the US, the Federal Reserve delivered its long-anticipated rate cut on Thursday morning, but then immediately warned that the December cut that every investor and their dog has priced in isn't as certain as it looks. And Australian investors are reeling from the fact that a Melbourne Cup Day rate cut looks absolutely no chance now after a hot inflation print on Wednesday. Anthony, now we love our interest rate predictions here on the Chanticleer pod, and you have been very strong on the idea that the RBA would just sit on its hands. Are you taking vindication from this inflation data?
I'm not sure it's vindication, James. And rates calls, particularly mine, are just pissing into the wind. But, the inflation was a reminder. We let the inflation genie out of the bottle in the post-COVID stimulus era. It's going to take years and years to try and jam it back in for good. And that's why the RBA's been so cautious with its rate cuts down cycle, James. We've been hearing predictions of 5 rate cuts, 8 rate cuts for the past sort of 2 years now. We sat at 4.35% for 15 months. The board started cutting in February this year, 3 cuts on. And what do you know? Just as the first couple of those cuts have started being felt in the economy, inflation's taken off again on them. So it's not an ideal situation at all, James. So for the September quarter, headline CPI jumped to 1.3% or 3.2% on an annual basis. The trimmed mean, which is what Michelle Bullock's always reminding us, is the important one.
Yep.
That's running at a 3% annual pace, well above the RBA's 2.6% year-end target. So if you had a chart, and I know this is a podcast, James, so charts don't really work, but just picture inflation trickling down to the right very, very nicely, but then, spiking up again in the September quarter. So going down for about 2 years or 3 years and then just ticking up again now. So, James, at the start of the week, the short-term money market said there was a 67% chance of a rate cut next week. Now they say it's only 7%.
Wow.
And I say to the market, come piss in the wind with me. We're on hold together. And if you really want to be in my camp, we might hold for a while yet. But, James, this is just Australia. Got the same thing going on in the US. We had the Federal Reserve meeting. What did they say?
Like the RBA, they're a bit worried about a bit of weakness in the labour market. But like the RBA, they're looking at the inflation numbers going, sorry, guys, that is not where it needs to be to justify more cuts. So Jerome Powell had an interesting meeting. For a long time, the Fed, which has double figures voting members, they've all been moving in lockstep together. But this time we had 2 dissenters. Stephen Moran, who's Trump's man on the Federal Reserve, he wants the rates to be cut by 50 basis points or double what the cut that was actually delivered. And then we had another Fed governor who said, I don't want any rate cuts at all. And so this has led Jerome Powell to say the rate cut in December that everyone thought was an absolute guaranteed certainty is not a foregone conclusion. And he came out and said that very strongly. The thing is, though, Anthony, the markets never really believe Jerome. They always think, he says that, but he'll still cut. and yes, I think he did indicate that the general direction of rates is still down. But I think we're in a similar situation in both Australia and America. The stickiness of inflation is just making central banks sort of have to look past what's happening in the labour market. And I don't know, it may be that both the Fed and the RBA are on hold for well into next year. Let's see how it goes.
The dissents thing, James, like one up, one down, it's quite remarkable, wasn't it?
Yeah.
I read this week it's only happened 5 times since 1990. So that's 5 times in the past 35 years. The board meets 8 times a year for their ordinary meetings. So a lot of meetings go through without these dissents. It was pretty remarkable. Was it just the politics, do you think, or do you think it's the actual economy?
No. I think the dissenters, that they're summing up what's happening in the economy. There is a case, if you look at the labour market, that you could cut rates harder. And there is a case, if you look at inflation, that you shouldn't cut rates at all. So in some ways, it's interesting. Like, we look at the Fed, they're all moving in lockstep, and we say, oh, that's groupthink. But now we see these dissenters, one up, one down, as you say, and we think, oh, hang on, is there tension on the board? You know, are they at war with each other? So, look, I think it's just capturing the US economy. It's just hard to read at the moment.
Okay, James, and you mentioned corporate Australia's trouble magnet. WiseTech Executive Chairman Richard White was back in the headlines this week, and incredibly, this time he has the fuzz on his tail. What on earth happened there?
Well, we got an ASX announcement from WiseTech this week, the logistics software technology company that White co-founded back in 1994. It's been a huge success, this business. But what you don't want to put out is a stock exchange announcement saying, yesterday we were raided by the Australian Securities and Investment Commission and the Australian Federal Police. And they were looking at share trades by Richard White and 3 other WiseTech employees.
Yeah, right.
Now, my information is that they were in the WiseTech offices from early in the morning until about 11 p.m. at night.
Jeez.
This is on Monday night. So they must have been collecting plenty of data or having a good fossick through the documents they needed. And this is just a horrible look. Obviously, Richard White had this series of issues last year. He actually emerged from that more powerful than ever at WiseTech. He's the executive chairman. He looks like the executive chairman for life. But now we've got WiseTech investors wondering, hang on, where does the company go next? Clearly, Richard White's super important to whatever WiseTech does. And now there's a question mark over where does his sort of role go from here? Anthony, it's just remarkable, really, how much trouble this company attracts. There's good business under here, but it just can't seem to get out of its own way.
It's a great business, James, and I think the only positive for WiseTech to come out of this week is we learnt that the ship has stopped leaking. The fact that the cops were there for so long, like you say in the story, didn't get out until they put the announcement out the next morning. That's quite remarkable, you know, because if there's one thing journalists should be good at picking up on, it's a raid.
Good point. We have to see where it goes. I mean, ASIC investigations are notoriously slow. They'll take their time. The investigation's ongoing. But in the meantime, WiseTech shares, after a combination of this raid and some concerns about their earnings, they're down about 35% in, a very short space of time. So investors are back in the mire with this one. There's a big share price mountain for this company to climb to get out of it. So let's see if it can do it, I guess.
Yeah, the governance issues are there and will be there for a while yet.
Okay, Anthony, let's put on the helmet and head for the trenches. A new super war has broken out. Now, the last big super war was between retail for-profit super funds, which used to be owned by the banks and wealth managers, and industry super funds, which are essentially sort of joint ventures between the unions and employer groups. You might remember the famous Fox in the Henhouse ads that the industry super funds put out to have a go at those for-profit funds. But the new battle is a little bit different. Industry funds are seeing competition from a different set of for-profit players. The big wealth platforms, which allow savers, usually advised by financial advisors, to use their self-managed super funds to invest in a vast range of funds and options. This is how John Pearce, the Chief Investment Officer of the big industry fund UniSuper, describes the battle at the Australian Financial Review's Super and Wealth Summit on Thursday.
We're still in a very healthy inflow position, right? But it would be remiss of us if we didn't acknowledge the fact that, the empire is striking back. We had the 90s and early 2000s. It was all retail were winning the battle. Then the industry funds were winning the battle. And now, if you look at net flows, it said that the empire is striking back, so retail are actually winning the battle in aggregate. That doesn't mean that we're losing. We're still, but we've got to work harder. That's the point. Because they have got a pretty good proposition, so we've got to work harder.
Anthony, you got to love this. You were hosting this panel. The Empire Strikes Back. It's a beautiful rhetorical flourish. What does it mean for Australia's super savings, though?
Yeah, there's a nice way with words. John Pearce definitely came up with some of the most memorable phrases of the day.
Yes.
First of all, James, this is a combination of old and new players. There's the old retail super players. They're still the retail super players, albeit what's working for them in their business at the moment has changed, and there's new faces that have joined them. So if you take MLC, for example, that's the company with the golden leg logo, founded about the same time Ned Kelly was captured at Glenrowan. Its core super fund, which it calls Master Trust, it's been leaking clients and been in outflows for years. But its wrap business, which sort of sits alongside the super fund, and it's called MLC Expand now, and is used by advisors to manage their clients' money, that's actually been growing quite quickly. Same thing's happening at AMP, Colonial First State, BT, like the old brigade in retail super. Alongside them, there's these new players that have come into the market, and the two most talked about are Net Wealth and Hub24, which didn't go through the Royal Commission. They were pumped up as these sort of like high-tech, easy-to-use platforms. They hoovered up advisors and now have a heap of advisors sitting on their systems and managing their money. I think they have about 14% of the platform market each, James. And Hub24 says it has 1/3 of all advisors in the country using them. So you now have the rise of these investment platforms, so including Hub, including Net Wealth, including the AMP Norths, MLC Expands. They've captured a big part of the money market, right? So it could be super money, it could be non-super money, but it's all the money that sort of sloshes around Australia's capital markets, Australia's share markets, and determines, who gets funded out there. So if you think about it, James, it's basically ordinary Australians. They want to take more control of where they're investing, where their assets are. They're saying, hold on, I've got this really big nest egg. I've got these great savings. I want to determine where I'm putting them. So there is this sort of like shift in where the money is going. But I think what Pearce is telling us is the competition for Australia's retirement savings as part of that has increased. And this fragmentation of super, and not just super, but where the sort of wealth is going more broadly, it's changing investor behaviour. It's changing liquidity in the market. So if UniSuper wants to sell a 5% stake in Transurban or 5% of an airport, it's hard to sell it to these investors that invest through platforms. It's much easier if he could just offload it to Australian Super or one of the other big players. So, he's been in the sector for decades, James. He used to run Colonial, so he's been on that retail side, and he's just kind of blown the whistle on a little bit, saying, watch this space. This super sector might be changing before our eyes.
I thought this point about liquidity is really interesting. Liquidity is like the beating heart of the super sector. It's the idea that when you need to get your money, the cash is going to be there, right? Mm-hmm. And what Pearce was saying is that because more flows are going to the platforms, that means that the super funds are going to need to be very careful about these unlisted assets. You can't liquidate an unlisted asset as quickly as you can liquidate a share in a public company.
100%.
That's something we haven't heard before, or at least I hadn't.
At the same time, funds are also getting more members moving into the retirement phase, which John Pearce termed, we've got a pig in the python here, as that aging demographic comes up through the super system. At the same time, he's also thinking about what's the liquidity requirements around them as well, right? So he's making a double liquidity point, James, here. They're coming at it from both sides. There are changes that are happening. James, you spoke to Wayne Swan, the former federal treasurer, who's chairman of CBUS. Your third interview with him in a row, as you pointed out at the summit.
Yes.
That's another big industry fund. He suggested that some of the people pulling out of the mainstream super and getting onto these platforms are being lured by what he called lead generators, who he accused of basically hawking or pressure selling. It's a big claim, isn't it, James?
Yeah, but CBUS is speaking from experience here. Their members, work in construction and energy. They also have media super, so they work in the media.
Yep.
And what they find is, a lot of their members do harder, more physical jobs. They retire a bit early. I think they retire at average at 60 years of age. So They need their super to work for them, but what they're finding is that these people are seeing social media ads, they're seeing social media posts, and they're going to check out these super comparison sites, which then, they put their name and phone number in there. They get a call from someone saying, oh, you should definitely come across and look at getting financial advice and moving onto the platforms and taking more control. And Swan, he says there's hawking going on here. He says as well as sort of early retirees, there's a big push to target men who are 25 to 35 and, perhaps think they can beat the market or whatever it is and want to take more control. So he's calling for some more regulatory intervention. I'm not sure we're at that stage yet. ASIC was at the Super and Wealth Summit and made the point that they're investment agnostic, that they're happy to see super funds and platforms compete with each other and go at each other. So I'm not sure Swan's going to get the regulatory intervention that he wants, but this is really moving quickly. And I thought it was, fascinating to see it brought up on stage. Where do you think the super war goes, Anthony? I mean, is it a bull market phenomenon? The big super funds have had it good for a decade. Is it good to see them on their toes a bit?
I think it is a bit of a bull market phenomenon, James. Like, if you look at your super fund, big super fund that you're probably in, and the returns you would have got over the past few years, you're probably making 10% a year. S&P 500's been up 20, 25% a year, right? So it's obvious to see that maybe there's an easier way to make some quick money out there and people taking control of their savings outside of the sector because it has been easier to make good returns. In terms of should we be worried, James, I mean, I think the last thing anyone wants in the super sector, particularly the regulator, is any sort of confidence shock, any notion that there's worry. I mean, if it's spread on the street that super's not safe or that platforms might necessarily be bad for the industry or industry funds aren't as good or whatever. I mean, if that caused some sort of investor stampede, I mean, seriously, watch out. Like, batten down the hatches. Imagine if there's $4.2 trillion was loose and switching around between the funds. We could kiss so much goodbye. But competition's a good thing, always a good thing. And, like John Pearce said, it's up to the industry funds now to fight back.
Work harder.
Hopefully they can do that through better net performance and more benefit to members. Hopefully it's not just about paying advisors more or, winning in some other way. But the industry funds, they've got no more right to manage 12% of your salary as they do anyone else, right? So it should be a competitive market.
We should emphasise too, Anthony, John Pearce wasn't saying that there's a looming liquidity problem like that's, months away. But what he's looking here is like 5, 10, 15-year issue. If this keeps developing, we've got to be aware of it. So, there's no trust issue now, but I'm actually heartened by the fact is that people like John Pearce, who's a really doyen of the super industry, is saying, hey, let's just watch this. Let's get on top of this and make sure we all know where we stand as these flows move around.
Yeah, James, it was a huge day at the summit. Give us another of your big takeaways.
Well, I was going to say advice, Anthony. I sat through, as I always tell you, I sat through so many Royal Commission hearings. We heard so many bad stories about advice, fees for no service, commissions out of control. But we've got a real problem. People are retiring with massive super balances, with their houses are worth a lot of money, and they need to be advised on how to do it. There's not enough advisors to do that. So we're going to need to look at different models. Now, the super funds are keen to get into this. Some people think that that's not the right thing. I know that, the banks will start looking at it. Again, some people think that that's not the right thing. But we're going to have to throw lots of different models here. There might be sort of limited advice, which is more like coaching or guidance or education. And then there'll be more sophisticated levels of advice for people with larger balances. But we've swung the pendulum very hard to make sure the advisors are really well qualified and properly remunerated and incentivised. But in doing so, we've forced a lot of people out of the industry, and now we need to build that industry up again. That is going to take time. That challenge of building the wealth advisory industry up is happening at the same time we're getting this wave of retirements that'll crash over the next decade. So just watch out for that. It's not going to be easy to solve.
Yeah, that pig in the python's coming, James.
Well said. And while we're on the topic, listeners should check out the latest episode of the AFR's 15 Minutes with the Boss podcast, where Sally Patton talks with Cbus's chief executive, Christian Fock. It was quite an interesting chat, that one.
Cafe breakfast every morning, James. Okay, James, let's move to our second topic. And last week, I said you'd have to be dead not to be excited about the James Hardie annual general meeting. And boy, was I right. For a meeting that lasted just 17 minutes and held on the other side of the world, the carnage was almost unthinkable. Investor anger over Hardie's takeover of another US building materials company called AZEK resulted in 3 directors being voted off the board, including, incredibly, the chairman, Anne Lloyd. James, this was an ugly end to an ugly episode. Was James Hardie contrite and full of apologies and promises to its angry investors?
No, that's the bit I don't get here, Anthony. I think it's okay for a company's performance to not be great. It happens. You know, markets change. You get caught out by things that you don't see coming. Investors can cop that. But this is about investors not being given a say on that deal. And then after investors were not given a say on it, and were clearly furious, palpable with rage, James Hardie has managed to annoy them even further by not even appearing to listen to their complaints. I mean, I think you wrote, Anne Lloyd didn't even come out to Australia for shareholder meetings.
Correct.
The most of the shareholder base is here. Surely you're walking around Sydney and Melbourne in the offices of big investors and big super funds, pleading for investors to calm down and back the company. But there was none of that from what I can see, Anthony. And then you get to this AGM on Thursday morning, 7 o'clock. You had to dial in to this meeting in Ireland because that's where James Hardie's fled to after its asbestos issues. And do we get like a grovelling apology to start the meeting? Oh, we're so sorry. We've misread this. We've got it all wrong. Please forgive us. We'll do better next year. No. I think their words were something like, we acknowledge that and we'll listen to investor feedback. Like investor feedback? They've just kicked 3 of your directors off the board. Feedback that. I just couldn't believe how badly this has been managed, Anthony. Does James Hardie just not care about the Australian investors?
I think they've moved on, James. They're a big American business. 85% of their sales are over in America, James. So, Australia's got the other 15% of the sales that's still listed here on the ASX because that's been its traditional home. Most of the shares are traded via the ASX, but it probably argues that they're mostly traded by offshore investors on the ASX, and they've just moved on, which is incredibly disappointing. What's fueling this rage, James, is there's a bunch of Australian fund managers that have covered James Hardie their entire career. They feel like they've always followed the story, always tried to do the right thing in the company, and then there's this new board, newish management team that's doing whatever they can to pick it up and take it to the US. And there's nothing wrong with having a US business listed on the ASX, James, and the ASX has supported Hardie's for years and years. But the real sting in the tail here, the thing that really gets investors in the teeth, is the way this deal and Hardie's movement in the past couple of years has been towards the impact of it on management's pay and the turning of the management pay structure into this US-style remuneration framework where management seems to be taking a lot of money out of the business, particularly cash, perhaps at the expense of shareholders. And that's really, I think, why they're so pissed off. It's one thing to do another bad deal, like you say. It's one thing to have a strategic misstep. And it's sort of another thing to stuff up your remuneration framework. But to do all those things at the same time and to not show any willingness at all to address any of them and perhaps even make them worse like it has with the remuneration report and the goals that it set for FY26 that were lower than FY25 despite doing what they said was a compelling strategic value accretive deal. It's just that hypocrisy amongst it all that's got the Aussies fired up.
Yeah, and they are seriously fired up. Anthony, do you think perhaps there's an element that James Hardie is prepared to go through this pain to have these 3 directors kicked off so they can sort of complete the job of Americanizing this company, reconstitute the board? Is there a sense there that James Hardie, the company, has sort of said, bring it on?
Perhaps, James. I mean, if you look at the board now, they've got 5 directors that are there from the James Hardie era, and they've got 3 new directors who did get voted up at the AGM, and they're all from the AZEK side of the transaction. So you've now got 8 directors, 5 from the old Hardies, 3 from AZEK. I mean, that's probably about the right weighting for the company. If you look at what the company is now. Problem is, though, there's no Australians on the board. There was only one Australian, PJ Davis, the director who back in his executive career was in charge of Bunnings over in the UK, and we know how that ended up. He was the only only Australian director on the Hardie's board, and he's been turfed out. So, I mean, the Aussies are fired up. They want to see more Australians on the board. Good luck to them. We'll see where it lands.
Yeah, it wasn't the only big AGM blow-up this week, Anthony. CSL, the big blood products giant, it had its AGM on Tuesday. This is one of the bluest blue chips on the ASX, but its shares are down 40% in the last 5 years. And if investors weren't angry enough, it served up an absolute poo sandwich on the day, didn't it?
Yeah, good way to put it, James. I mean, everything CSL said at the results in August, basically forget it. You know, its vaccine business has run into anti-vax sentiment in the US. The flu shot isn't selling early in the season over there like it should. And CSL has spent a lot of money designing and making vaccines that it's probably going to have to bin.
Yeah.
You know, now vaccines are, in the scheme of things, a reasonably small part of CSL's business. The main thing for them is blood and blood-based treatments. But it's enough that CSL had to revise its FY26 revenue and earnings forecasts, only issued in August, and delay the proposed spin-off of its Seqirus vaccines arm, once again, only announced in August. So, as far as the share price is concerned, I mean, the main thing is that earnings downgrade. It's now saying 4 to 7% profit growth, down from 7 to 10%. When a company grows at 4.6%, James, it's worth less than a company growing at 7 to 10%, right? That's what it comes down to.
Yep.
Now, obviously, the earnings number is going to be lower as well. So you get this really big downgrade going on, and that's why the shares have sort of fallen 40%. And you wrote, James, in August that CSL was doing very un-CSL things, you know, a spin-off, cost cuts, clamping down on R&D, all that sort of stuff. Well, this week we got more un-CSL things. You know, it's downgrade after downgrade. The CFO, Joy Linton, resigned quite suddenly in early October, which was a surprise, and had a bit of a change the messenger feel about it. And then we got a strike to its remuneration report as well, which unfortunately is becoming a bit of a CSL thing because it was its second one in 2 years. But it should never happen to, as you said, the bluest of blue chips companies on the ASX. Shareholders didn't vote to spill the board, and to be honest, you wouldn't expect them to either. I mean, remuneration reports, strikes on them have been in since 2011. No board's been spilled yet. That's not sort of what they're about. The other thing we're seeing a little bit, James, is that the proxy advisors are showing a bit more teeth this AGM season, particularly Glass Lewis, which is one of the two big US firms in the Australian market. You know, they were seen as a bit of a box ticker perhaps in the past. This year, they seem to be really firing up. And I wonder if it's a reflection of the investors' anger. And James, like, investors do seem angry out there. What do you think's driving their anger? And is it a case by case, or are there some bigger themes at play?
I think there's some bigger themes at play here, Anthony. And on Thursday at the Super Summit, we had Sean Manuel. He's the head of Australian equities at Australian Super. You had him on one of your panels. He's the biggest Australian equity manager in the country. I think he manages about $100 billion of Australian equities. So when he speaks, everybody listens. And he had these amazing lines. Quite amazing. He said he's never seen companies as short-term focused as they are now, and that's because they're all worried about the next quarter. They're not investing for the long term. Ironically, CSL's not one of those in that basket, but I think you do have to manage the short term and the long term to be able to, you know, earn the trust of investors. And the other thing he said, which is really interesting, is that he reckons companies have become entitled. And that's because if you're in the ASX indexes, the ASX 200 and the ASX 300, you can depend on getting some money from super funds into your companies, and you can depend on getting some money from the big passive investment strategies, ETFs. Is that part of the story here too? I thought this was a really interesting take from Sean that goes to the idea of deeper anger. It's not just that dumb companies are doing dumb things. It's that companies are coasting, and they're coasting in a way that is short term and not good for, you know, super savers who are trying to think 5, 10, 15, 20 years ahead.
Absolutely. Sean's hobby horse, this one, James. I think it's worth listening to. I think you could also just as easily turn this around and say that investors and markets have never been more short-term focused, which plays into the hands of the stockbrokers, the ticket clippers, you know, everyone else involved in that turnover advisor game. I'd say the game's a lot more short-term focused. So companies and investors, we're more sort of risk-averse, conservative and constipated for it. You know, everyone's so worried about staying within their sort of rails and not doing anything to stop this flow of passive money that can send up the share price. it was sort of sowing the seeds for our own 2% a year economic growth, James,
exactly.
unlike the 3% that, we had in the past 40 years, and would be better for all of us. But I mean, I think at the heart of Sean's gripe is the way that a lot of investors are just following what's in the index, right? The performance test in the Australian superannuation sector, it's been great for members in terms of weeding out underperformers, but it does encourage investors to invest in line with the benchmark, or maybe just slightly above or slightly below the ASX 200. That sends money automatically into the biggest stocks. If you're on the board or management team, you just got to stay in your lane, just try and maintain your spot in the index. You're going to get these capital flows behind you. The big thing though, James, once again, it comes back to management remuneration frameworks. So like the way to fire up corporate Australia, the way to make sure they're not entitled and that shareholders are getting looked after, it's all in the way the pay's structured. And I know it's AGM season, so that's why it's fresh in my head at the moment. But I think that's kind of at the heart of the debate here.
Yeah, absolutely. All right, Anthony, let's come back after the break. It's a massive week for banks of all types. Back in a sec.
A new true crime podcast you need to hear to believe.
I need police right now. I'm just stabbed and broken into my house.
2 men dead at the hands of a teenager, and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alva Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alva Beach, Death at the Door, wherever you get your podcasts.
Welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. Okay, Anthony, we have a couple of bank results next week. We've got Westpac on Monday, we've got NAB on Thursday, and Macquarie on Friday. This is going to be the story of, can these things actually deliver a bit of growth, isn't it?
Yeah, I think it's going to be the cost cut story, isn't it, James? Like what productivity improvements are there at the banks?
And on Tuesday, it's the big one, the RBA rate decision into the Melbourne Cup at 3 o'clock. Give us the tip on the RBA.
Yeah, I'll take the easy one. That's hold. What about on the horses, James? What do you like?
Okay, well, I think the favourite half yours is going to be very difficult to beat, particularly if it rains, as is expected in the next few days in Melbourne. But I've got a very Chanticleer podcast tip for you, Anthony. It's a horse, 50-1, called Flatten the Curve. I've done a bit of research here. It's owned by a German fund manager. I think this is a good one. It's never lost when it's run on grass tracks. I know the German fundy, a guy called Eckhart Saron, is very excited to be down in Melbourne. He thinks his horse is a good chance. So if you're looking for a roughie, the financial minds are with Flatten the Curve. So there you go.
Good stuff.
We love a question here on the Chanticleer podcast. This week our question's from John in New South Wales. If you've got a question you want to send in, email us at chanticleer@afr.com. You can also send your question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. Or you can use the widget on afr.com on the bottom of all our Chanticleer articles. So John asks, as a significant proportion of CSL's business is US-based, would it make better sense to co-list its shares there to attract greater US and international investor support? Anthony, this is right up your alley.
Please no, John. I mean, yes, what you say makes sense. The US is a massive market for CSL. I'm sure dozens and dozens and dozens of investment bankers would have gone to CSL over the years and pitched them this one. But I think Australian investors would be really, really keen to see it stay on the ASX and just the ASX, because once you let them go, like we saw with James Hardie, things can get out of control pretty quickly. Now, the ASX has been a great home for CSL. It's had CSL's back all the way through its growth story since listing more than 20 years ago now. There's a bit of a bump at the moment, but I think investors here know it really well, understand it well. The support will return for CSL once it finds its sort of footing in this new sort of growth outlook that it's talking about. So I don't think it needs to go to the US. But John, you're talking just like an investment banker. And, I'm sure there's some sort of rationale to it.
There's a big commission coming your way, John, if CSL can pull this off. All right, Anthony, great answer. It's been a big week, and next week we'll dive into the banks and a little bit of horse racing as well.
Good luck at the Cup, James.
Thank you. Thanks for listening. We'll talk to you next week. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com, and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald, and it was produced by Mandy Coolin and Alex Gow. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.
A new true crime podcast you need to hear to believe.
I need police right now. I'm just stabbed and broken into my house.
2 men dead at the hands of a teenager, and almost every moment recorded.
Please, don't move.
Put the knife down.
I was just trying to help her.
What happened at Alba Beach was as horrific as it was baffling.
There's so much contradiction. We should know more than we know.
I'm Adam Hegarty. I'll take you inside one of the country's most confusing investigations in this exclusive 60 Minutes podcast.
Ambulance, police, inquest, a domino effect of failures. It's killing us.
I'm not a police officer anymore. I can speak more freely.
Alba Beach, Death at the Door, wherever you get your podcasts.